In May of 2010, a programmer named Laszlo Hanyecz made this post on a really obscure internet message board.
Right, I remember reading about
Yeah,
this.
he offered 10,000 units of this experimental digital currency to, anyone who would order him 2 large pizzas.
And someone actually took him up on it, right?
Exactly. The pizzas arrived, and history was pretty much made. It was the very first real-world transaction for a completely new, totally anonymous technology.
And today, I mean, those 2 pizzas would cost you roughly $807 million.
Which is just, it's mind-bending. But honestly, the price tag isn't even the craziest part of this whole story.
No, not at all.
What's truly wild is that Wall Street institutions, the very same financial titans who spent years calling this tech a scam or a bubble or a vehicle for fraud, are now pouring billions of dollars into it.
It's a massive reversal.
It really is. Welcome to the Deep Dive. I'm Jonas, and I'll be one of your guides today as we unpack this massive shift.
And I am Monique. Welcome to the show. Today is Wednesday, May 13th, 2026, which is also the exact date we finalized the extensive research for this discussion. You are tuning into Macroeconomy, and our deep dive today is Crypto Assets Explained.
And we really want to extend a massive thank you to you, the listener, for spending part of your day with us. We love diving into these complex topics together.
We really do.
So please, engage with the show, share your thoughts, and keep the curiosity alive. And before we really get into the weeds, we need to highlight our sponsor.
Right, the channel Macroeconomy.
Exactly. Bringing you a compilation of analysis and news on macroeconomics, technology, and artificial intelligence.
And it's also, I think, really critical to set the ground rules for today's exploration before we jump in.
Oh, for sure. This is a highly debated topic.
Very much so. We're looking at a space that evokes, well, very strong emotional and financial reactions from people. Our analysis today is 100% impartial.
Right. We don't take sides here.
Exactly. We're just here to detail the possible scenarios, unpack the systemic risks, and really extract strategic insights from the data. None of the information presented here constitutes an investment recommendation or financial advice of any kind.
Not at all.
This is purely an educational breakdown to help you understand the mechanics of the market.
Which brings us right to the sheer scale of the beast. Because to understand the risks and where all this is heading, you first have to grasp the magnitude of the modern crypto market.
It's definitely not a niche internet experiment anymore.
Not even close.
Yeah.
As of today, May 13, 2026, the total cryptocurrency market capitalization sits at approximately $2.68 trillion.
Trillion. With a T.
Right. Out of that massive pool, Bitcoin is the undisputed heavyweight. It dominates the landscape at around $1.62 trillion all on its own.
Wow.
Yeah, and it's trading near $80,700 per coin. Meanwhile, Ethereum trails as the second largest, sitting at roughly $280 billion.
To put that $2.68 trillion into perspective, I mean, that is larger than the GDP of many developed nations.
Yeah, it's staggering. And the engine running all of this is blockchain technology.
Right. And for a long time, the dominant analogy was to call a blockchain a public Excel spreadsheet.
I've heard that one a lot.
Yeah, but it really fails to capture the security mechanics of it all. Instead, I want you to picture a massive bank vault made entirely of bulletproof glass, just sitting right in the middle of a public square.
Okay, a glass vault.
Exactly. Everyone walking by can look through the glass. They can see exactly how much money is in every single safety deposit box.
So total transparency.
Total transparency. And they can watch the funds move from one box to another in real time. What they cannot do, however, is reach inside.
Because of the bulletproof glass.
Right. Only a person holding a specific, highly complex cryptographic key can authorize the movement of those funds.
That transparency is fascinating, especially when we consider the recent frauds we'll talk about later. But keeping that glass vault secure comes at a massive cost.
It does.
And this is where I usually get kind of hung up. Bitcoin runs on a system called proof of work, right?
Correct.
And the narrative out there is that keeping this system secure requires as much electricity as a medium-sized country.
Yeah, that's a common talking point.
So if Wall Street is so obsessed with environmental, social, and governance goals, ESG metrics, how do they justify buying into an asset that requires boiling the oceans just to keep the lights on?
Well, hey,
Like, what are the actual mechanics behind this huge energy consumption?
it's actually not an exaggeration to compare the energy use to a nation-state. According to the Cambridge Center for Alternative Finance, Bitcoin consumes roughly 138 terawatt hours per year.
Which is just massive.
It is. But to understand the why, we have to look at the actual mechanics. Proof of work is essentially a global cryptographic lottery.
Okay, a lottery, how does that work?
To process transactions and secure the network, specialized computers called ASICs compete to solve a mathematical puzzle.
And these ASICs are basically massive server farms, right?
Yeah, exactly. They're designed to do nothing but guess numerical combinations millions of times a second. The first one to guess the right answer gets to add the next block of transactions to the chain.
And they paid for that.
Right, they are rewarded with brand new Bitcoin. The energy isn't a byproduct here. The energy expenditure is the actual security wall.
Wait, so burning the electricity is what makes it safe?
Yes. You would have to match that massive global electricity output to even attempt to hack the network.
Ah, I see. So the inefficiency is actually a feature, not a bug.
Exactly.
It's a deliberate physical barrier protecting that digital glass vault.
But I keep seeing data suggesting the environmental panic might be, well, slightly overblown or at least lacking context.
It often lacks a lot of context.
So what is the actual energy mix powering all these machines today?
That's where the nuance really lies. Over 52% of the energy used for Bitcoin mining now comes from sustainable sources.
Oh, wow. Over half. Yeah. Because miners operate in this hyper-competitive market where their only variable cost is electricity, they are naturally incentivized to hunt down the absolute cheapest stranded energy on the planet.
So they aren't just plugging into city grids.
Usually no. They set up next to remote hydroelectric dams, or they utilize flared natural gas from oil fields that would otherwise just be burned right into the atmosphere.
That makes a lot of sense. They go where the power is basically free or wasted.
Exactly. Furthermore, it's critical to note that the broader crypto market has largely moved away from this model anyway.
Right. Ethereum changed things.
They did. Ethereum executed a monumental software upgrade back in September 2022 called the Merge. They abandoned proof of work entirely and shifted to proof of stake.
Right, right. And if I understand the mechanics of proof of stake, it essentially replaces electricity with capital.
That's a great way to put it.
Like instead of buying thousands of computers and burning power to prove you have skin in the game, you just take your existing Ethereum and lock it up in a digital vault as a security deposit.
Precisely. You prove your honesty by risking your own capital.
And what happens if you try to cheat?
If the network catches you trying to validate a fraudulent transaction, the protocol automatically slashes your locked funds.
Ouch.
Yeah, you lose your money instantly. And by removing the need to run massive server farms, Ethereum reduced its energy consumption by 99.95% literally overnight.
That is a staggering technological pivot. Okay, we understand the massive scale, and we understand the underlying engines, both the energy-heavy proof of work and the capital-heavy proof of stake.
Right.
But if we really want to understand the heartbeat of this market, we have to talk about the halving.
Oh, absolutely. The halving is crucial.
This is arguably the most unique economic mechanism ever coded into an asset. Every 210,000 blocks, which translates to roughly 4 years, the reward that Bitcoin miners receive for solving that cryptographic lottery gets automatically cut in half.
And we actually just passed through the fourth halving in history on April 20, 2024.
I remember that.
The block reward dropped from 6.25 to 3.125 Bitcoin. In practical terms, that means the daily global supply of newly minted Bitcoin dropped from about 900 coins a day to roughly 450 coins a day.
Let me stop you there and apply a real-world analogy, because this concept is just so alien to traditional commodities.
Sure, go for it.
Imagine a literal gold mine. If the global demand for gold suddenly skyrockets and the price shoots up, the mining company's response is pretty predictable.
They mine more gold.
Exactly. They hire more workers, they buy bigger excavators, and they pull more gold out to capture the profit. And that increased demand eventually creates increased supply, which naturally cools the price down.
That's economics 101.
But Bitcoin doesn't care how many server farms you plug in.
Not at all.
The code strictly dictates that only 450 coins will be produced today, no matter what. It is an entirely inelastic supply.
Yes, completely programmatic.
So does this mechanically force the price up?
Well, it is incredibly tempting to look at that inelastic supply and declare that upward price action is a mathematical certainty.
Right, because less supply means higher price, theoretically.
Theoretically. But we have to be rigorous here and separate correlation from causation. Historically, yes, the data paints a very persuasive picture.
Because it went up after the past ones.
Exactly. In the 12 to 18 months following the halvings of 2012, 2016, and 2020, the asset saw massive percentage gains.
Huge bull runs.
But as the Bank for International Settlements frequently points out, macroeconomic factors really dictate the broader tide. You have to consider the global liquidity environment and the cost of capital.
So what the wider economy is doing matters more.
Much more. If a halving occurs during a severe macroeconomic recession where interest rates are sky high and investors are fleeing risk assets, that supply cut will not magically save the price.
Because nobody's buying anyway.
Precisely. The halving chokes the new supply, but if the demand side completely evaporates, the price will still collapse. Past performance, as the fundamental rule of finance dictates, is never a guarantee of future results.
That makes total sense. Choking off the supply only matters if people still actually want to buy the asset in the first place.
Exactly right.
And the demand side of this equation is where the story gets incredibly paradoxical.
It really is a paradox.
Because right now, the demand is being driven by the most conservative institutions on the planet.
Yeah.
I mean, in January 2024, the U.S. Securities and Exchange Commission approved 11 spot Bitcoin exchange-traded funds, or ETFs, all at once.
And that approval fundamentally rewired the market structure.
Yeah.
You had the largest asset managers in the world, like BlackRock, stepping into the arena.
BlackRock is huge.
They are. BlackRock's ETF, the IBIT, surpassed $1 billion in assets under management in its first week alone.
Just 1 week.
Yeah. And by the time we hit early 2026, the collective assets under management for these ETFs blew past the $200 billion mark.
That's just wild.
You have institutions like Fidelity and ARK invest openly publishing reports on the digital gold thesis, with ARK projecting the total market could hit $16 trillion by 2030.
But hold on, let's unpack this paradox for a second. How on earth does a traditional asset manager walk into their compliance department and say, hey, we want to launch a massive fund for an asset class that just experienced two of the most devastating, high-profile financial frauds in modern history?
It's a tough sell on paper.
Because if we rewind just a couple of years to 2022, this market wasn't a Wall Street darling at all. It was the Wild West, and the bodies were just piling up.
The contrast between 2022 and 2026 is seriously whiplash-inducing.
Totally.
In May of 2022, the market witnessed the catastrophic death spiral of the Terra Luna ecosystem. This was an algorithmic stablecoin project.
Let's clarify that mechanism, because the term stablecoin implies safety.
Yeah, yes, usually.
A normal stablecoin works like a digital casino chip. You give the company a real U.S. dollar, they put it in a real bank account, and they hand you a digital dollar token.
Right. It's backed one-to-one.
If you want your real money back, you return the token.
Yeah.
It's fully backed. But Terra wasn't backed by anything in a bank.
Right.
Exactly. Terra attempted to maintain its $1 peg not through real-world cash reserves, but through an algorithmic relationship with a highly volatile sister token called LNA.
Okay, sounds risky already.
Very. The code allowed users to burn $1 worth of LNA to mint 1 Terra and vice versa. It relied entirely on market arbitrage to keep the price stable.
But what happened when things went south?
Well, when confidence broke and everyone rushed for the exit at once, the algorithm entered a hyperinflationary death spiral.
Like a run on the bank.
Exactly. To try and maintain the peg, the system autonomously minted trillions of LNA tokens, driving the price of both assets effectively to zero.
Trillions of tokens. Wow.
Yes. Between $40 and $45 billion in wealth literally evaporated into thin air in just 72 hours.
That is just catastrophic.
It was. The founder, Duquan, was ultimately sentenced to 15 years in prison in late 2025.
And before the smoke even cleared from that Terra collapse, we hit November 2022 and the FTX implosion.
Okay, the FTX disaster.
At the time, FTX was viewed as one of the most trusted cryptocurrency exchanges in the world. I mean, they had stadium naming rights. They had Super Bowl commercials.
Tom Brady was in their ads.
Exactly. But the fraud, there wasn't a failure of blockchain technology, right? It was just the oldest centralized financial crime in the book.
It was pure embezzlement. The founder, Sam Bankman-Fried, had essentially built a backdoor in the exchange's accounting software.
Unbelievable.
He took billions of dollars of customer deposits money that people thought was safely sitting in their accounts and secretly funneled it to his private trading firm to make incredibly risky bets.
And he lost it.
He lost it all. When the market turned against him and customers tried to withdraw their funds, the money simply wasn't there.
A classic Ponzi-style collapse.
Basically. It resulted in an $8 billion hole and a 25-year prison sentence for Bankman-Fried in 2024.
Which naturally brought out the critics, as it should. You had prominent economists like Nouriel Roubini calling the entire industry the mother of all scams.
Oh yeah, the pushback was fierce.
And the Financial Action Task Force was issuing these dire warnings about systemic money laundering risks. So I have to come back to the question, how did we get from the smoking crater of FTX in late 2022 to Wall Street pouring $200 billion into ETFs by 2026?
The answer lies in a rather brutal concept called survival bias, coupled with a massive regulatory cleansing.
Okay, unpack that. A regulatory cleanse.
Right. The collapses of 2022 were horrific for the individuals who lost money, absolutely. But systemically, they functioned as a controlled burn.
A forest fire that clears the deadwood.
Exactly. The destruction fleshed out the bad actors. The over-leveraged hedge funds, the algorithmic Ponzi schemes, the fraudulent exchanges, they were completely eradicated from the ecosystem.
So the market was forced to grow up.
Exactly. Moreover, the sheer embarrassment of these collapses forced global regulators to finally stop just issuing warnings and start writing actual hard rules.
Which Wall Street loves.
They demand it. What Wall Street found in 2024 wasn't the Wild West anymore. It was a sanitized, vastly more transparent market, structurally ready to be packaged into highly regulated ETFs.
So the carnage was actually the catalyst for institutional adoption.
Paradoxically, yes.
The collapse forced the rules to be written. And those rules look drastically different today. For instance, the European Union rolled out the MiCA regulation, which explicitly banned the algorithmic unbacked stablecoins that caused the Terra disaster.
Or we saw equally aggressive frameworks take hold in Latin America, too.
Right.
The Brazilian regulatory landscape is now considered one of the most robust globally. They passed Law 14.478 in 2022, but the real operational teeth came from the central bank, the BCB.
Their resolutions, right?
Yes. Their resolutions 519, 520, and 521 went into full effect in February 2026.
And there is one specific mechanism in those Brazilian resolutions that directly addresses the FTX trauma, and that is mandatory asset segregation.
That's the key rule right there.
Essentially, the law now dictates that if an exchange is holding your digital assets, they cannot commingle your funds with their corporate treasury.
Which is exactly what FTX was doing.
Right. If the exchange goes bankrupt now, or if the CEO decides to make terrible trades, your assets are walled off. It physically prevents another Sam Bankman-Fried scenario.
It builds a very necessary firewall between corporate liability and customer assets. And the regulation didn't stop at consumer protection either. It extended heavily into taxation.
Governments always want their cut.
Oh, always. In Brazil, capital gains on crypto now face rates ranging from 15 to 22.5%. And staring down July of 2026, the country is implementing the Decrypto reporting system.
The Decrypto system.
Yes. It aligns local tax authorities with international OECD standards to ensure total fiscal visibility, so there's no hiding anymore.
But while governments are busy regulating decentralized cryptocurrencies, they aren't just sitting on the sidelines watching, are they?
No, they're actively building a competitor.
We are seeing the rise of CBDCs, central bank digital currencies. Brazil has developed the DRX, and China has had the digital yuan or ECNY circulating for years now.
It's a huge shift, but it is vital to understand that a CBDC is fundamentally different from Bitcoin or Ethereum, even though they both exist on digital ledgers.
How so?
A CBDC is entirely centralized. It is issued, controlled, and monitored by a sovereign government.
So it's basically government crypto.
Essentially, it takes the technological efficiency of blockchain, like instant settlement and programmable smart contracts, but it strips away the trustless, decentralized ethos that birthed the crypto movement in the first place.
I have to say, the whole CBDC movement feels a bit like the Empire Striking Back.
That's a great way to describe it.
I mean, Bitcoin was explicitly created in 2008 to remove governments and central banks from the financial equation, right? To give people money that couldn't be inflated or censored.
That was the original dream.
And the government's response is essentially, we love the technology you built, but we're going to use it to issue our own money so we don't lose our monopoly on the financial system.
And that tension is really the defining conflict of the next decade of finance.
It's setting up to be a massive clash.
Absolutely. On one hand, institutions highlight the incredible efficiency of CBDCs. A government can instantly distribute stimulus funds directly to citizens' digital wallets or program the money to only be spent on certain goods.
Which sounds great for efficiency.
It does, but that exact programmability triggers massive surveillance and privacy alarms.
Oh, I bet.
If the government issues the digital money on their private ledger, they can see every single transaction. They can freeze an individual's wallet with a single keystroke.
That's terrifying for privacy advocates.
It is. This fear is so profound that in the United States, Congress advanced the Anti-CBDC Surveillance State Act specifically to prevent the Federal Reserve from issuing a retail digital dollar.
Wow, they actually passed a law to stop it.
Well, they advanced the act, arguing a CBDC could be weaponized to monitor and control citizens' spending habits. We are looking at a future where deeply centralized government digital money directly competes with decentralized, permissionless crypto assets.
It's just an absolutely wild journey to reflect on, right?
It really is.
We started back in 2008 with a 9-page PDF written by an anonymous author.
Satoshi Nakamoto.
Right. And we moved through people buying pizzas for hundreds of millions of dollars, through brilliant technological breakthroughs, to billion-dollar frauds that landed founders in federal prison for decades.
It's a movie script, honestly.
And now, here in 2026, we are staring at a $2.68 trillion asset class where the most conservative Wall Street firms are acting as custodians and sovereign governments are frantically coding their own digital currencies just to keep up.
It's a true testament to the resilience of the underlying technology. But it's also a stark reminder that navigating this space requires an understanding of systemic risk and macroeconomics that goes far beyond just looking at a price chart.
Absolutely. You can't just look at the line going up or down anymore.
Not at all.
Which brings us to a final provocative thought for you to carry into your week.
Let's hear it.
If we have reached a point where traditional massive banks now custody our Bitcoin through regulated ETFs, and governments are successfully issuing their own trackable digital currencies, has the crypto revolution actually changed the global financial system? Or has the traditional financial system simply swallowed, sanitized, and co-opted the crypto revolution?
That is a phenomenal question to end on.
Something for you to mull over.
Definitely. And with that, we must present our final mandatory disclosures before we sign off today.
Right, over to you for that.
This material is a compilation of open projections and information from third-party sources and is strictly for informational and educational purposes. It does not seek to present any ideological bias. It does not constitute an investment recommendation or financial advice of any kind. Projections are subject to frequent revisions according to new information obtained, new external facts, and even new narratives. Likewise, past performance is no guarantee of future performance.
Well said.
That was today's Macroeconomy Abba. We are stopping here, and to you, stay well and keep an eye out for our new broadcasts. Subscribe to our channel, access the links, and follow Macroeconomy on social media.